Welcome to DWS Market Update. 2025 has seen quite a few interesting developments so far. For one, US trade policy has undergone a substantial change. Tariffs on imports into the US have been raised significantly. But we have also seen some notable changes in Europe. In Germany, the constitutional debt brake has been modified to allow higher deficits. And in addition, a fund to finance investments has been introduced. The US Federal Reserve has paused its interest rate cuts, meaning that the US policy rate still remains above what is generally considered a neutral level. The European Central Bank, on the other hand, has continued to cut interest rates and has now reached what we would regard as a neutral interest rate. What is the bond market's assessment of the economic prospects for the two major economic areas? Real yields are generally regarded as an indicator that reflects the market's expectations for real economic growth. Since the beginning of the year, 10-year real yields in the US have fallen from around 2.25% to 1.8%. The market, therefore, now considers the prospects for real growth in the US to be weaker than at the start of the year. For Germany, on the other hand, the market has raised its growth expectations, although German real yields are still well below those of the US bonds. Credit default swap prices can be used to track the market's assessment of credit risk. The default probabilities implicitly contained in these instruments have risen since the beginning of the year in the case of the US, while they have fallen for the Federal Republic of Germany. Finally, let's have a look at inflation expectations. These can be measured by the difference between the yields of nominal versus inflation-linked bonds. In the case of the US, inflation expectations priced over the next 10 years have risen since the beginning of the year. On average, the market now expects an inflation rate of 2.4%. The same calculation for Germany shows that the market expects an average inflation rate of 1.75% for the coming years, which is slightly lower than at the turn of the year. This also means that the investors assume that the European Central Bank will probably achieve its inflation target for the coming years. For Germany, compared to the beginning of the year, the bond market now sees somewhat higher growth prospects, an improvement in credit quality, and lower inflation. That's it for today. Thanks for watching and goodbye.